Hello, this is Principles of Finance in Chapter 2. We're going to be talking about the financial market environment today. Firms require funds, and they get these funds through external sources. They can get them in one of three ways. First is through a financial institution. A financial institution accepts savings and transfers to those who need funds. The second is through a financial market. These are organized forums where suppliers and demanders of funds can make transactions. And finally is through private placements. And this is where suppliers and demanders of funds transact business directly. Financial institutions are intermediaries. Examples of financial institutions include commercial banks, credit unions, insurance companies, pension funds, and mutual funds. They channel the savings of individuals, businesses, and governments into loans or investments. In the United States, the key suppliers of funds are individuals, and the demanders of funds are businesses and governments. Commercial banks are institutions that provide savers with a secure place to invest their money, and they offer loans to individuals or business borrowers. The traditional activities of a commercial bank work as depositors believe their deposits are secure. The United States government provides deposit insurance up to $250,000 per account to further this belief that deposits are secure. Investment banks are institutions that assist companies in raising capital, advise firms on major transactions such as mergers or financial restructurings, and engage in trading and market-making activities. The same act of Congress that introduced deposit insurance also created a separation between commercial and investment banks. The same institution that takes deposits cannot also engage in the riskier activities of securities underwriting and trading. This is again to further the belief that deposits are secure. They don't want commercial banks who are taking your deposits to engage in these excessively risky activities. The Glass-Steagall Act of 1933 created the FDIC. This is what instituted the $250,000 insurance per account, and it assures that investor money is safe. This promotes safety and sound in the financial system. This act, which created the FDIC, the Federal Deposit Insurance Program, also separated the activities of commercial and investment. The separation of commercial and investment banking activities was repealed in the 1990s. The 90s also saw rapid growth in what is now known as the shadow banking system. These institutions engage in lending activities but do not accept deposits, so they lend like but do not deposits. So an example of the shadow system would be a pension fund. They have access to cash to invest, and a company may need the money, so an investment bank may take the money and act as an intermediary between the two parties. Markets, commercial banks. In a market, transactions are made directly. So the suppliers of funds and the demanders of funds are acting directly with one another. Loans are granted without the direct knowledge of suppliers of funds in a commercial bank. In a financial market, suppliers know where the funds are being invested. Transactions in short-term marketable securities take place in the money market, while transactions in long-term securities take place in the capital market. To raise money, companies can either use private placements or public offerings. Most companies use public offerings, the sale of bonds or stocks to the general public. But a private placement involves the sale of a new security directly to an investor or group of investors. The primary market is the financial market in which securities are initially issued. This is the only market in which the issuer is directly involved in the transaction. So this is the only time that the issuing company is going to receive any of the proceeds from the sale of their assets, of their stocks. The secondary market is where pre-owned securities are traded. So an example of a secondary market would be the New York Stock Exchange. You go in there and you can buy and sell stocks between investors. The company is not on either side of the trade. And so here's a picture of this graphically. Here we see how money is transferred from the suppliers of funds. In the United States, those are typically households, and the demanders of funds, typically business and government. So they take one of three paths. The first would be through a financial institution. The second would be private placement, and finally would be a financial market. So to go through a financial institution, the savers or investors would deposit money into the financial institution, and they would provide loans to the demanders of funds. In a private placement, the suppliers and demanders are acting directly with one another, and they're trading funds for securities. And through a financial market, the suppliers of funds are purchasing securities through demanders of funds. The money market is created by a financial relationship between suppliers and demanders of short-term funds. When we say short-term funds, we generally mean that they have a maturity of 1 year or less. Most money market transactions are made in marketable securities. These are short-term debt instruments. Examples of this would be United States Treasury bills, commercial paper, negotiable certificates of deposit, businesses, and financial institutions. Investors generally consider marketable securities to be among the least risky investments available. So why does the money market exist? Why would you want to purchase or invest your money for such a short period of time? So some companies, some entity may have idle funds that they want to invest in a relatively safe, interest-bearing asset. Other entities need seasonal or temporary financing. So this would bring the two parties together. A lot of companies have very seasonal businesses, and they know that they need money to get through the bad months. The capital market is a market that enables suppliers and demanders of long-term funds to make transactions. These would be trading bonds, common, and preferred stock. Bonds are debt. These are long-term debt instruments. They generally pay interest semi-annually. They will have a stated interest rate, a par value, and initial maturity, usually between 10 to 30 years. These are used by businesses and government to raise large sums of money from a diverse group of lenders. Common stock represents units of ownership. A person would earn money by owning common stock by receiving dividends of cash or by realizing increases in share price. So you could see a return to you in either way, but they do represent units of ownership in a company. Preferred stock, this also represents ownership, but it's a special form of ownership. It is equity, like common stock, but it does have features that make it similar to debt. Preferred stockholders are promised a fixed periodic dividend. So common stockholders don't have this right. They aren't promised anything. They only receive money if there's anything left over. So preferred stockholders are promised this dividend, and if the preferred stock is cumulative, then that dividend has to be paid before any common shareholders can receive anything. So if it's cumulative, then that means that if a preferred shareholder does not receive their dividend payment this quarter or this year, the company has to make that dividend payment back up to them before they can pay common shareholders anything. If it's non-cumulative, they still are entitled to their dividend that period, but if for some reason the company can't make that dividend, then the next period they don't have to make up the previous dividend before they start the second one. So they do receive their dividends before common stockholders, but the degree to which they receive them differs whether they're cumulative or non-cumulative. Broker markets. These are securities exchanges where two sides are brought together. So the buyer and the seller are brought together to trade securities. These make up 60% of all shares traded in the United States. Examples would include the New York Stock Exchange. So I like to think of this like a real estate broker. The real estate broker is bringing together the buyer and the seller. They're not having a interest in the trade. They don't actually own the house that's being sold. And that's the way this works. There's someone bringing them together and they receive a fee for doing so. Dealer markets are markets where the buyer and seller are not brought together directly, but instead have their orders executed by securities dealers that make markets in a given security. It is made up of a large number of market makers who are linked together via a mass telecommunications network. So an example of this would be NASDAQ. So I like to think of this as a car dealership. Especially a used car dealership. Whenever you're purchasing the car, you're purchasing it from the dealer. You're not purchasing it from the previous owner. So the previous owner has sold it to the used car dealership. The used car dealership is now selling it to you. So they're making money on the difference between what they paid for it and what they're selling it for, just like dealer markets. So in a dealer market, they're making money on the difference between the bid and the ask price, what they've paid for it and what they're asking for it. In recent years, the distinctions between broker and dealer markets have blurred because telecommunications networks have become so advanced that these dealers are holding securities for nanoseconds. It's like they barely even actually own them. There are electronic trading platforms that use sophisticated algorithms to place buy and sell orders very rapidly without any necessary human intervention. From a firm's perspective, the role of capital markets is to be liquid. This means that the market exists with many bid and ask offers. There are low spreads, low volatility. It's easy to execute trades quickly at desirable prices because there are numerous buyers and sellers. From an investor's perspective, the role of capital markets is to be an efficient market. So this is just meaning that all funds are being allocated to their most productive uses. If the market is efficient, the price of a stock is an unbiased estimate of its true value. Changes in stock price reflect new information investors learn and act on, and the more efficient the market, the more rapidly the process works. So greater fluctuations in stock price mean that new information is being introduced to the market on a continual basis. Not everyone believes that markets are efficient. We do not exactly know how efficient markets are. Prices do move with new information, but it is difficult to identify over or undervalued securities, and very few have bet correctly for an extended period of time. Excuse this slide. Many even believe that insider trading should be allowed. So many of you may remember Martha Stewart. She was convicted of conspiracy, obstruction, and making false statements to federal investigators. She served 5 months in jail, 5 months of home confinement, 2 years of probation, and a $30,000 fine. Some allow that insider trading should be allowed because investors would be able to quickly convert this inside information into publicly available information if insider trading were permitted. Others argue that it should not be allowed because insider trading may provide incentives to hold back information for personal gain. So there are a whole lot of regulations that regulate financial institutions. We already talked about the Glass-Steagall Act of 1933, which established the FDIC and separated investment and commercial banking activities. Others, such as the Gramm-Leach-Bliley Act of 1999, allowed mergers between commercial banks and investment banks. So it basically undid the Glass-Steagall Act of 1933, the second part of it. It is interesting to note if you look at historical trends in banking regulations, as the economy does well and banks seem to be safe, Congress repeals regulations, and so they have a more lax, more free environment. But as bad things start happening, most specifically, a crisis like we recently had, Congress will imply a lot of new regulations on a bank that they must comply with. So it really looks like a roller coaster ride. There's a whole lot of regulations, and they take a bunch off, and then something bad happens, and so they add a bunch on, and then the banks start whining because there's such a burden to meet all the regulations that they repeal some, and then something bad happens, and so it's up and down throughout time. Other regulations, the Securities Act of 1933. This regulated the sale of securities to the public via the primary market. So it required extensive disclosures to potential buyers of securities. So when someone wanted to go public, they had to put out a lot of information about their company. The Securities Exchange Act of 1934 regulated security tradings in the secondary market. So now it's requiring that not only do you have to provide extensive disclosures when you go public, you have to continue to make those disclosures once you are public, so that people within the secondary market know what's going on. This established the SEC, the Securities Exchange Commission. They are the primary government agency responsible for enforcing federal securities laws. It requires ongoing disclosure. So you may remember from our Edgar video where we looked at 10Q, 10K, 8K statements, proxy statements. All of these are published because of the Securities Exchange Act of 1934. So prior to the 1970s, local banks took deposits and made loans to local borrowers. A process called securitization changed the way mortgage financing works. So securitization is the process of pooling mortgages or other types of loans and then selling claims on these securities in the secondary market. A specific type of securitization would be mortgage-backed securities. These represent claims on the cash flows generated by a pool of mortgages. They can be purchased by individual investors, pension funds, mutual funds, or virtually anyone. Mortgage-backed securities are purchased by investors, and as these mortgages are repaid, the premiums and interest are given to the investors. Banks still lend money to people who want to build or buy a new home, but then they typically bundle these loans together and sell them to organizations that securitize them and pass them on to investors around the world. So the primary risk associated with these mortgage-backed securities is that homeowners may choose not to or may not be able to repay their loans. Prior to 2008, most investors viewed mortgage-backed securities as safe. And here's why. If we look at the home price index, from July 1995 to April 2006, the index rose continuously. There was not even 1 month of decline. So as home price increased, the gap between what the borrower owes on the home and what the home is worth widens. So there's this natural built-in equity that's occurring every single month. When the value of your home is increasing, you have equity that you can tap into. If borrowers have trouble making the payments, then the lenders would allow borrowers to tap into this built-in home equity to refinance their loan and lower their monthly payments. Because mortgage-backed securities were so safe, lenders began relaxing their lending standards. This led to tremendous growth in what is now called subprime mortgages. Subprime mortgages are mortgages that are made to borrowers with lower incomes, poor credit histories, not the most prime candidates for lending. Another feature of these subprime mortgages is that these loans typically have adjustable interest rates. They are not fixed. So if interest rates increase, then their payments would increase. Financial institutions increased their holding in the mortgages. By 2000, real estate loans made up 40% of the total loan portfolio of large banks. Home prices began falling in May 2006. They fell from May 2006 to May 2009. Home prices fell more than 30%. When homeowners had difficulty making the payments, refinancing was no longer an option because these homeowners were underwater, meaning that they owed more on their home than what their home was worth. By 2009, 25% of subprime borrowers were behind schedule on their loan payments. And because banks were so heavily invested in real estate, this decline in home values caused trouble for them as well. So banks don't usually fail. It's very, very rare that you see a bank fail. In 2007, there were 3 banks that failed. 2008, there were 25. 2009, 140 banks failed. In 2010, 157. In 2011, 92. So this picture above shows stock prices for banks. Bank stocks fell 81% between January 2008 and March 2009. As a result, banks began tightening their lending standards and drastically reduced the number of loans they made. Lending in the money market declined. Remember, this is short-term funds. So companies that had seasonality problems that regularly used the money market found that it was no longer possible for them to get money, or it was only possible at very, very high interest rates. So therefore, it affected businesses. So businesses began cutting expenses, which caused the economy to further decline. This provides a clear picture of why financial institutions are so important to our economy. A recession that is associated with the banking crisis is so much more severe because so many businesses rely on credit to operate. When financial institutions stop lending, activity in other industries slows too. Because modern economies are so sensitive to bank crisis, governments regulate financial institutions and markets more than any other sector in the economy. And so here we can see pictures of this. This is the number of severe mortgage delinquencies in 2006. Here, green is good. So green means that everything's going well. Red is bad. So in 2006, the majority of the country is green. There are very few mortgage delinquencies. This is 2008, December of 2008. There are a whole lot more yellow, orange, red sections. Notice too these sections of the country that have a whole lot of mortgage delinquencies. Notice that they're concentrated in vacation areas. So if you are wealthy enough to own 2 homes, you are much more likely to default on your second home than you are your primary residence. This is December 2009. There's not much green left in the country. December 2010. Again, vacation areas are hit the hardest. And this is December 2014, so things have started clearing up a bit. California is back to completely green. Our section of the country, Western Kentucky, was not hit too badly. And so our final section of this chapter is about business taxation. I know it's a little odd. There's not really a good segue to leap into this, but it is a part of this chapter, so we do need to cover it. Both individuals and businesses have to pay taxes on their income. The income of a sole proprietor or a partnership is taxed at the income of the individual owners. So they're taxed at the individual income rate because sole proprietorships and partnerships are not separate legal entities. Corporate income is subject to corporate taxes. Both individuals and businesses have 2 types of income, ordinary and capital gains. Ordinary income is the income that you earn from ordinary day-to-day operations. Capital gains, that is when you sell an asset for more than that asset originally cost. And so we have a corporate tax rate schedule here to allow us to calculate taxes owed. And the way that you read this, you first look at the left-hand side of the table and you look at your range of taxable income. So you determine what bracket you fall into. So let's say perhaps that you have taxable income of $250,000. That falls between 100 and 335,000, so you use the corresponding equation. Your base tax would be 22,250 plus 39% times any amount over $100,000. So let's work this. Here's our equation. We have earnings of $250,000, so we use this equation. We have 22,250. This is our taxes owed. 22,250 plus 39% times anything over 100,000. So we have 250,000 minus 100,000. And so that's 80,750. Now make sure that you're following your order of operations. So you subtract the 100 from the 250, multiply that by 39%, and then add to it your 22,250. So the marginal tax rate is the rate at which additional income is taxed. So what would be your tax rate on the next dollar earned? So here we earned $250,000. If we earned $250,001, we would still be in this same bracket, so our marginal tax rate is 39%. Marginal tax rates, there are no calculations necessary. You simply look at the table and you choose the appropriate marginal tax rate. Average tax rates are different. Average tax rates, you do have to do some calculations, and it is the firm's taxes divided by taxable income. So for our example, our company had $80,750 in taxes. And they had $250,000 in taxable income. So that means their average tax rate is 32.3%. 32.3%. So capital gains are the amount by which the sale of an asset exceeds its purchase price. For corporations, capital gains are added to ordinary income and taxed like ordinary income at the firm's marginal tax rate. So here's an example. Ross Company earned $120,000. So the $120,000, this is their ordinary income. During 2013, the company sold an asset for $150,000 that originally cost $125,000. So our capital gains is the amount by which the sale price exceeded the purchase price. So $25,000. So we can calculate our total taxable income. That would be equal to capital gains plus ordinary income. So that's $25,000 plus $120,000 to give us $145,000 in taxable income. So now we can calculate our taxes owed. To calculate our taxes owed, we need to go back to our table, and we see that $145,000 is still the same equation. It lays between $100,000 and $335,000. So our base tax is $22,250. Plus our marginal rate of 39% times any amount over $100,000. And so that is $39,800. So we can calculate our marginal tax rate. Remember, our marginal tax rate, there's not any calculations necessary, it's simply 39%. Our marginal tax rate is 39%. And our average tax rate is taxes owed divided by taxable income. So the $39,800 Divide that by 145,000. And that is 27%. So here's another example. Company XYZ earned $175,000 last year. They also sold a piece of machinery for $22,000 that originally cost $19,000. So our ordinary income is $175,000. Capital gains is $3,000. So our taxable income is $175,000 plus $3,000 to give us $178,000. So we're still in that same bracket. So we have our taxes owed, $22,250 plus 39% times any amount over $100,000. So that is $52,670. So our marginal tax rate, again, 39%. Our average tax rate is $52,670 divided by 178,000. And that gives us 29.6%. So for corporations, a corporation can own stock in another corporation. It's common. Most of that stock is preferred stock. But for corporations only, if a company, some of the dividends that they receive from the company is excluded from taxation, dependent upon the amount of ownership that they actually hold. So the greater the amount of the company, the greater the percentage ownership in the company, the greater the amount of dividend exclusion from taxation. And so this is not just a flat number, it is a scale. But as their ownership increases, the amount of exclusion increases as well. And so this helps mitigate the effect of double taxation. So once a company earns income, that income is taxed at the corporate income tax rate. Once it's paid to shareholders, shareholders have to pay taxes on that money that they received at their personal income tax rate. So if there isn't any exclusion here, then this money would essentially be taxed 3 times. All interest income that is received is fully taxed, however. So corporations, they get to deduct their operating expenses, and they also get to deduct their interest expenses, but they do not get to deduct the dividends that they pay on their common stock. So this creates a built-in advantage for companies to choose to finance their operations with debt. However, debt is risky. It creates a fixed burden on the company. They have to meet fixed obligations every month, every period. And so it is risky in the fact that they may not have enough cash flow to support these fixed obligations. So a company does want to have debt in their financing structure, in their capital structure, because it is advantageous from a tax standpoint. However, the greater the amount of debt, the greater the risk, so the greater the possible bankruptcy costs. So they don't want to have so much debt within their capital structure that they can't meet those obligations as they come due. And so here we have an example. We have 2 companies. We have a company that has debt and a company that doesn't have any debt. Both have expected earnings before interest and tax of $200,000 in the coming year. So we have debt company and no debt company. Their earnings before interest and tax, both of them, $200,000. Because debt company has debt in their capital structure, they have interest expense on that debt. And their interest expense is $30,000. No debt company has no interest expense because they have no debt. So that gives us our earnings before tax Now we subtract our taxes. Let's just say a 40% tax rate. 40% of 170,000 is 68,000, and 40% of 200,000 is 80,000. And so that gives us our earnings after tax. So for debt company, that's 102,000, and for no debt company, it's 120,000. So these companies had the same earnings. However, a debt company had $30,000 more in expenses than no debt company, but their earnings after tax is only $18,000 different. So this shows you the built-in tax advantage for using debt in your capital structure. Debt financing can increase cash flow and earnings per share and can decrease taxes paid. The tax deductibility of interest and other expenses reduces the actual after-tax cost to a profitable firm. And it is the non-deductibility of dividends that result in double taxation under the corporate form of organization.